Hi everyone, it's Terry Gardner from C.J.L.12.6.23 coming to you from Midtown Manhattan. It's Wednesday, December 6th. I've got some brief market commentary for you today. Got 4 points that I want to cover. The first being, I want to take a look at the inflation at the Thanksgiving dinner table. Something we covered as a preview in previous years. We're doing a review this year. Secondly, we want to take a stock on where we are in the broader economy with regard to interest rates, inflation, and growth. And then thirdly, let's take a look at earnings, see where they've come in for the third quarter and what the outlook has in store for 2024. And then finally, we want to highlight a couple of sectors where we think the earnings growth potential for next year looks particularly attractive. And we want to highlight specifically the industrial sector. So first off, Thanksgiving dinner. Hope everyone had a great Thanksgiving. In past years, we have always previewed the American Farm Bureau's study of inflation at the Thanksgiving table. Every year, they do a study and compare prices of a basket of items that are consistent over time. They've been doing this for decades. If you remember when we did this last year, we noted that the Thanksgiving dinner cost was up 22%. In 2022 versus 2021. So really catching an inflation drift there. This year that's reversed itself a little bit. So your Thanksgiving dinner, thankfully, was down about 4.5% from last year's peak. A couple of items worth noting because we always like to see what the menu has in store and where the inflation and the disinflation lie. The turkey cost you 5.6% less this year. Actually, a particularly good year for the turkey flock. A couple of other items that I found interesting. The big decliner for the year were cranberries, which were down 18.3%. So thanks to all of our friends up in the cranberry bog up there in Massachusetts. And the big up years were pumpkin pie mix and sweet potatoes. So there you go. We'll parlay that into a discussion. Point number 2 on inflation and interest rates and growth and what the forecast looks like for next year. So interestingly enough, core inflation has been coming down, still relatively high versus historic levels, but coming down, and is now looking at FactSet consensus. You could probably use other sources of consensus, but I think they're all kind of around the same area. So whether you use CapIQ or Bloomberg, the FactSet consensus for next year's core inflation is 2.9%. So coming down, quite dramatically from where we've been over the last year or two. Likewise, 10-year Treasury bond yield outlook for next year has declined to 4%. That had been up around 4.5%. So core inflation coming down, Treasury yields coming down, and then finally real GDP expectations. So adjusting for inflation are only 1.2% for next year. So if you believe the consensus that we're seeing in most of the for most of the service providers of financial data, the consensus is that we're expecting a soft landing for next year. What does that actually mean? I mean, when you think about soft landing, you can think about going down a slide when you were a kid. At the bottom, it either steepened and there was a big drop off at the end, or it graduated and flattened out and it was a nice, easy, soft landing. So, that's what the expectation is for. People get hurt in hard landings. We're hoping for a soft landing. So thirdly, let's take a look then at what earnings look like for next year in a soft landing environment. And actually, that picture is a little bit even more bright than the outlook for GDP and the economic forecast. So looking at S&P earnings for 2024, expectations according to FactSet are for S&P 500 earnings to grow about 11.5%. There's a couple of sectors, to our third point, that I wanted to note that are seeing strong growth next year and saw strong growth this year. So 2 years back-to-back double-digit earnings growth. You can usually find some winners in those sectors. First off would be the communication services sector. Secondly, consumer discretionary, both with back-to-back double-digit earnings growth years. And then finally, I want to note the industrial sector. Been a little bit of a sleeper. No big up or down years. 11.5% growth this year, 11.5% growth expected for next year. Technology had a softer year this year, but is expected to re-accelerate 16% growth next year. So there's a couple of sectors where you can find some opportunities for appreciation. But to our fourth and final point, the reason I was highlighting industrials was because we think that there's some real opportunities within that sector, not necessarily tied to economic activity, accelerating or decelerating, but based on secular tailwinds in the economy driven by onshoring and reshoring. As we've seen over the last couple of years, companies, U.S. companies that have moved abroad are continuing to move their manufacturing capacity back to the United States or launch new capacity in the United States, whether onshoring or reshoring existing. And that number of companies that are announcing reshoring or onshoring initiatives is at an all-time high. And you don't often pick this up in the economic data that's released by the Census Bureau and others. But according to the Federal Reserve Bank of St. Louis, they track U.S. manufacturing construction spending. And for the first time, that figure is now over $200 billion on an annualized run rate basis. So that tells you, and again, that's not data that's captured in capacity utilization or industrial production figures. This is new construction of manufacturing facilities. So, we think that's quite tied into the initiatives around reshoring and onshoring. Additionally, an additional catalyst, I should say, to this construction spending is certainly private investment, but a lot of public incentive programs as well. Whether it's manufacturing tax credits that companies receive, the CHIPS Act, which was passed, the Inflation Reduction Act, which has a lot of incentives in there for manufacturing capacity. There's a real package of incentives at the federal, state, and local levels for manufacturers to grow and to initiate new projects here in the U.S. Much of that new manufacturing capacity is being fueled by automation and robotics. So what's happening is the labor cost advantage for overseas manufacturing is disappearing. So whereby companies used to have to go overseas to try to gain an advantage and lower their manufacturing costs, automation and robotics is allowing them to manufacture here in the U.S. at a competitive rate with manufacturing overseas. So that's an important catalyst additionally to the growth in manufacturing here in the U.S. And clearly access to cheap energy. We've read plenty and heard plenty about how expensive energy costs, how high energy costs are in other OECD countries around the world. On a relative basis, the United States U.S. manufacturers have a cost advantage in terms of energy costs. So, and of course, having access to the largest consumer economy in the world is attractive to manufacturers seeking to build new plants and reshore existing operations. So summarizing, a couple of things. The consensus is for a soft landing in the economy. We'll be watching to see if there's any deviation from those expectations. Earnings expectations are for double-digit growth for next year for the S&P 500, 11.5%. That's pretty robust. And again, finally, we see some really interesting opportunities in the industrial sector, which is showing nice, steady double-digit growth, but particularly with companies that are experiencing the secular tailwinds of onshoring and reshoring. So if you've got any questions about that, give me a ring at 212-888-6403 or shoot me an email at tgardner@cj.lawrence.com. I look forward to hearing from you. Thanks.